Hi everyone, I am moving on to Chapter 6, Problem SE5. In SE5, we are asked to figure out what the company is going to collect. The company sold merchandise to Bar Company, and they have terms of 210 net 30. 210 net 30. When you see that, you need to realize that that means if you pay within 10 days, you can take 2% off your bill. Or if you pay within 30 days, you'll owe the whole bill. Okay? Okay, so on April 15th, Sanborn Company sold merchandise to Bar Company for $3,000 on terms of 210 net 30. Okay, so we started out with the sale of $3,000. Assume a return of merchandise on April 20. So this happened on 4/15. On 4/20, we have a return of $600. Okay, so now we're down to $2,400. Then it says, assume they pay their bill in full on April 25th. What is the amount we will collect? Okay, well, April 25th meets the 10-day deadline to get the credit. Okay, so if they paid on April 25th, we would subtract 2% from the total amount they owe. Okay, so that would be 0.02 times 2,400, that'd be $48. Okay, so they would collect $23.52. Okay, now let's move on to SE6. In SE6, we are going to make journal entries. Now it says record them in T accounts, but I'm going to make journal entries because otherwise, I'm afraid you won't see the debit and the credit together, okay? So I'm going to make them as journal entries. And then you can post them to T accounts if you wanted to see what the balances were in the accounts. Okay, so on August 2nd, now please note that the problem says, assume we are using the perpetual inventory method. As you read in the chapter, the perpetual inventory method requires that you are constantly updating inventory when you purchase things and when you make a sale. Okay, that's different than the periodic method where we just collect up all of our purchases in a temporary purchases account and we do not update inventory for purchases or sales until the end of the period, and we do a when we do a physical count of the inventory. And not very many people do that anymore. Maybe a very small retailer that can actually just look around their store and see what they need to reorder. Most companies, because even QuickBooks, which is, you can buy for $200 online or at Best Buy, even QuickBooks can help you keep your inventory on a perpetual basis. And many people, your cash register actually is a computer and can help you keep your inventory on a perpetual method. So very few people use the periodic system anymore. Okay, so we're focusing on perpetual. Even though I expect you to understand how periodic works, we're really focusing on the perpetual method. So on August 2nd, I purchased merchandise on credit from Beer Company, invoice dated August 1st, terms net 10, which means I'd have to pay the whole bill in 10 days, FOB shipping point, which means it belongs to me from the shipping point. So when it leaves Vera, it belongs to us. Okay, and that doesn't really matter on my entries, but I would need to know that at the end of the year, or if it got damaged, I would need to know. Okay, it doesn't really change our journal entries when we're making the purchase. Okay, so this is a perpetual system. So I am going to debit inventory for $11.50. And it says on credit. So I'm going to credit accounts payable because I owe the company for this. They will invoice me and we will pay it later. Okay? Then, on August 3rd, I don't know why this is blurry. Looks like it doesn't, the autofocus is not really working for me. Okay. August 3rd, received a bill from Strauss Shipping for the transportation cost on the August 2nd shipment. Invoice dated August 1st, terms net 30. Okay, so apparently we paid the shipping and we owe for the shipping. Okay, so I'm going to call that freight in. Now, I will warn you that you might go to work for an employer and they put their freight right into the inventory cost and consider it to be a direct, you know, they want it attached to those direct items. Lots of people don't do that because then it's hard for you to see exactly what you pay per item. You would have to calculate that. Most people still use freight in, even in the perpetual method. Okay? August 7th. We returned damaged merchandise received from Vera on August 2nd for credit, $180. Okay, on the perpetual method, when we want to return goods, we actually just take them out of our inventory. We're not going to pay for them, so the first thing we need to do is debit accounts payable for the $180 that we want to return, $180 worth of goods. We will not pay that to the company, so we need to reduce accounts payable, and then we will directly reduce inventory, which is different than the periodic method. So see, inventory is constantly increased and decreased as the goods are going in and out of inventory. And then on August 10th, we paid in full the amount due to Vera for the purchase of August 2nd, part of which was returned on August 7th. So we are going to reduce accounts payable for what we owe Vera. And what do we owe Vera? Well, $11.50 minus $180. Okay, $11.50 minus $180. I'm going to put that in parentheses here so when you're looking at this later, you'll remember where we got that number. Okay, so let's see here if I can do the math on the fly in front of everybody. Does that look right? Yeah, $11.50 minus $150 would be $1,000, so it's 30 less. Yeah, that's right, $970. And then, how do I pay them? I write a check, so we credit cash. You haven't done that for a while. That's back to the basics for you. Okay? So that's the end of this problem. Let me move that up a little bit. Okay, that's how we make those. Now we are going to redo this problem using the periodic method. I'm going to do it right over here. So if I kept my inventory on the periodic method, meaning that I didn't try to track all the ins and outs on inventory, I would make some of my entries would be very different. Okay? On August 2nd, I would debit purchases for $11.50. And I would still credit accounts payable. We still owe it. That's the same. On August 3rd, when I got the bill for the freight, that would be exactly the same. On August 7th, we want to return damaged goods. So what's not going to change from the perpetual method is that I still owe them this money. Okay, I owed them, and so I'm going to reduce what we owe them. Okay, that's the same. What's different is that I actually have a different account called purchases, returns, and allowances. It's a credit account that is a contra account to purchases. Now, why do we do that? Why don't we just credit purchases? Well, because this gives us a way to quickly see that we're having to return a lot of stuff. And if we're having to return a lot of stuff, we probably need to look at our suppliers and try to figure out why they're sending us substandard goods. So that's just, see, it has a credit balance. It's a contra account to purchases. Okay? Again, I don't make any entries to inventory until I do a physical inventory. On the 10th, we pay our bill. And guess what? No differences. We still have to pay them what we owe them, which is the total bill minus what we returned. And we write a check to do that. So you're going to credit cash. Okay? So you can see the fundamental differences on the purchases side. Now we need to move on and do a problem that shows the differences on the sales side as well. Okay.